Thank you very much. Thank you, Diala. Thank you, Your Excellency. I'd first like to join by thanking Christof and welcoming him to the region. It's, I think, a great honor for all of us to have one of the world's leading thinkers in energy now based in Abu Dhabi, and a privilege to be able to call on his deep experience. For those of you who have been with us in the past, you'll know that a little about the voting. So we're going to ask the inevitable question, and that is, where is the average oil price going in 2015? When we gathered a year ago, up to 50% of us said it was going to be, I think, $150 or somewhere above 120. But on average, 80% said it was going to be 100 and above last year, 12 months. And for most of us, in that sense, oil prices nearly averaged $100 last year. So we're pretty accurate on the assessment. Let's see what we will do this year. So if we can bring up the question, the screen's all around. You can pick up your view of the question. Basically, this is what you need to have in your hand, is the clicker. And it's very simple. There's 5 answers. So you press 1, 2, 3, 4, 5. If we can bring up the question, please. And the simple answer is you choose which one of these 4 you think is going to be the average oil price in 2015. Not the lowest oil price, not the highest, but what you think is going to be the average price for Brent, that is, in 2015, which we saw in the last week drop below $50 a barrel. So please cast your votes. You can see it on the screens on the left, on the right. So basically, 1 is $40 or lower, 2 is in the 50s, 3 is in the 60s, 4 is in the 70s, and 5, 80 or above. So we can have a 10-second countdown, and everybody, your last vote, the last press of the button will be the vote that registers. So let's see where the room is feeling. Where's the love? In the 60s. Okay, 41%, 28 in the 50s, and 70s, 20%. That's our optimistic side of the room. So there's the result. 3, I suppose, the largest vote in the middle of the average, 60s. Christof, your thoughts? You didn't have a clicker, but which would you have voted, and what do you think of the result?
When I used to work in the industry, then the inevitable answer to the inevitable question where oil price is going to be would have been, if I knew, I wouldn't be working for you.
You wouldn't have been working for BP.
I think that applies to most of us. It's more distributed probably than I would have thought, and that reflects something which I think is an important theme. I'd like to connect to one remark Mr. Senora made, which is in times of volatility, it pays to go back to basics. It's also true for simple things like oil markets and economics. And then when you want to go back to basics, often it pays to look back into history. And we have to be aware where we come from. Why was this such a shock that prices went down so much? Largely because over the last full 3.5 years, since the very beginning of 2011, we have seen 2 things. We have seen the highest average oil price ever in the history of this industry, and we have seen, it may surprise some people, the most stable oil prices since 1970, since prices were no longer posted in the history of the industry. 111, 111, and 109 on average. I did the numbers before I came here, just as a footnote. The average price for last year is still 94, 93.97. So why does this matter? Because, of course, these very stable 3.5 years of oil prices to which all of us got used did not reflect a stable situation at all. In the background, we had this massive growth of North American unconventional US shale production, which is truly massive by historic proportions. You do the numbers again. It turns out what happened last year in the US in terms of annual production growth, if you exclude situations where countries had spare capacity, and so therefore they cut 1 year and had spare capacity, you only look at organic growth. That was the 4th biggest increase in annual oil production in the history of global oil markets. Any time, any country. So that was massive and doesn't look like a stable market. Why did prices last so long, so high, so stable? Because we had an equally historic development on the other hand, which again directly relates to your speech, Excellency. which is that we had these supply disruptions, mostly in North Africa and the Middle East, starting at the same time as shale oil production started. The civil war in Libya, production disruption in Syria, Yemen, South Sudan, the sanctions against Iran. And it turns out, when you contrast these two developments, they match each other almost barrel by barrel, almost one by one. Even the time profile looks similar. So that means that was not a stable situation. That was living on the edge. And it was just a matter of time and a question of which side the system would fall down. Would there be more supply disruptions, more unrest, therefore a price spike? Or would there be gradual increase in the US and therefore a price decline? It turned out that with a sudden return of production in Libya and a little bit of production return in Russia, that was enough to drive the system over the cliff and make prices fall so much. But it's very important, I think, to realize that in that situation, had we had only the shale growth in the US, we would have seen prices coming down much earlier. Talk about OPEC cuts, talk about what this means for producers, all the things we see now. And had we not had the supply growth in North America, only these supply disruptions here, we would have seen prices spiking, talk about releasing the strategic petroleum reserve, talk about damage to the global economy, all the rest of that program. Because it happened so late, it's really one of the most remarkable episodes in the history of economics, not just oil markets, this coincidence of factors. Because it happened so late, the adjustment now we are seeing is very volatile. And it leaves
what about on the demand side? I mean, in a lot of ways, we seem to take our eye off demand over that period, which obviously was weakening, particularly in China.
Demand was weakening, but this is different from the 80s. Demand was not negative. It's also different from the financial crisis. And Saudi Arabia, in that situation, if there were any discrepancies, sort of returned to the role of swing producer, balanced the system. But important is the endpoint. The endpoint was one when prices came down finally, where OPEC faced a true dilemma, a very unpleasant choice. Because what could you do now in the situation? The only question was to cut or not to cut. Cutting would have meant prices return to 100 or so. That would have meant North American production growth continues to take off like a rocket. That would have meant loss of market share. That would have meant loss of revenues. Not cutting would have meant prices come down and also a loss of revenues. In that situation, I think a rational first step was to let prices adjust and to stop.
Are you surprised that prices have come down as aggressively and as fast as they have come down?
Yes. Despite me always arguing that this is a system which is not stable but on balance, I'm surprised at it. But I think overshooting in this situation after 3.5 years of an artificial balance is quite normal. What this points to also is you see the uncertainty in the outlook because, of course, these reasons for supply disruptions have not gone away. Now the whole discussion is focused when and how fast will US shale react. But the underlying potential for disruptions or for a diminishing disruption, sudden increase in production is still there. And that makes the situation rather unpredictable.
Maybe we'll bring up the second question, which is what is the impact going to be of this sudden downward shift on global production capacity? And what is the most likely impact of the new oil price range on adding global production capacity over the short to medium term, i.e. the next 2 to 5 years? What will this lower? There's Saudi minister, essentially the largest producer in OPEC, has certainly signaled that the desiring to impact higher cost producers should be essentially pushed out of the market. So will that happen? So we're looking for your thoughts on what is the most likely impact of the new oil price. It's kind of an all of the above question, but essentially we're looking for your views on what's the most likely. If we could also bring a clicker for Christof so he can vote, if somebody could do that.
You got to trace it.
Plans for the new capacity remain intact over the medium term as investments are already committed. So essentially over the midterm, no change to the outlook for building capacity. Two plans for new capacity of unconventionals will be mothballed, deep offshore, and others. Gulf oil producers will accelerate new capacity as oil service companies slash fees. 4, US shale to stop adding new capacity and possibly existing capacity decline by the end of 2015. So that extra 4 million that have come on over the last 5 years may start to decline. Or 5, which is not oil but gas, There's a huge amount of gas capacity to come online, and new investments in the next few years will be derailed by the collapse in the oil index gas price, which is heavily defended by the Gas Exporting Countries Forum. And so if we could vote 10 seconds, number 1, 2, 3, 4, 5, what is the most likely impact of this development? Okay, number 4, U.S. shale to stop adding new capacity, and existing capacity may decline by the end of 2015. Nearly gets 50% of the vote, but also a kind of an even split between 1 and 2. New capacity remains, things get mothballed. Christof, your thoughts on that result, and what your view, which one you voted?
A bit surprised about because the question really requires an assumption, which is what you think about prices the next 5 years.
Yeah.
That answer implies that people think that prices will be considerably lower than they have been over the next 5 years.
Well, I suppose if you're making a calculation right now about where you're going to commit to production, you've got to take a view on where prices will be over the next 5 years, but you're also obviously guided by what price is now.
Yes, but I think, again, there's basics here at work which are important. When you look at the industry, even before prices starting to come down, what was the rallying cry? It was all about what investors wanted was capital discipline. And I think that's the first important point to realize. Is going to be capital expenditure in large capital-intensive projects in the Arctic, in deep water in Brazil, which are hit first. Behind that principle is a principle, a basic principle at work for a long time, which said in oil markets, global oil markets, cost always follows price. So if you have periods of price decline, after a while, costs will come down. The famous truck driver in North Dakota will no longer get $200,000 as a starting salary, but $100,000. The way that works is by cutting capital-extensive projects first. That gives you a first list of an impact. But secondly, equally important, I think one has to realize that shale, unconventional production in general, also heavy oil, oil sands, is different from what we have seen before. And it's different in the sense that it is more flexible to react to prices than conventional oil. You compare what happens today with the 1980s. In the 1980s, new production was coming on, mostly the North Sea and Alaska, on a scale almost comparable volume-wise with what we have seen now from shale. Market was smaller, but same kind of volumes. When prices came down, most of these projects were run by private companies. They had an almost binary choice: continue production with these large projects or shutting them in. They all had bills to pay, credit to repay, cash flow to generate. They decided to continue production, all of them, and to eat the cost. And as a result, we went through a massive, massive round of cost cutting in the industry, and prices stayed low for 15 years. This is different because shale production gives you much more scalability in the supply response because of the high well intensity. These are not wells producing 3, 4, 500,000 barrel each. These are a lot of small wells producing a little, and when prices come down, you take out the most expensive wells and the supply response. And when prices come back up, you bring those wells back into production.
So do you think the impact, which seems to be the target for OPEC, that the shale producers start to show some discipline and maybe to not add new capacity, is that a realistic goal over the short term?
Yes, I think the important conclusion of that second point of shale being different is, number one, this will be more complicated and more drawn out, this attempt to limit production, because there's this flexibility. And number two, the strategic variable to hit, as you said, is investment. In order not to lose further market share, it's not done with a short-term price decline and then these projects stop, like in the good old world, which creates these long-term cycles. When you stop deep water, 10 years later there will be less oil. This will be a longer period during which one has to see whether investment continues. But there's a very important third point. At the moment, all of us are just talking about how investment gets hit and suffers. Because oil markets are not just pure economics, but also political, it is also quite likely that we see increases in supply from some corners. Think Russia. They had made a strategic decision to direct their investment flows in very expensive and unknown technology in the Arctic. That's off the table, most likely. They also have huge supplies of unconventional oil in the Bajano field, shale oil. They have access points which they need to generate for investment. They have old fields which are dry now in Siberia, but which sit on shale rock. A lot of Western companies very eager to get there and apply these technologies. That may change the picture, the low oil price and the tremendous capital cost as opposed to the higher operation costs for shale.
Would you see in the number 3 vote there, 6%, which seems a little low to me, that Gulf producers will take advantage of the low price to add capacity in this region?
I don't see that the Gulf producers overall, taken all together as a group, will
well, individually, inevitably, in the sense that if the cost of production decreases, as you say, along with the price, that's an opportunity in which to add capacity and to be ready on the upside when demand recovers.
These are not situations where you have private companies trying to maximize long-term profits, so I would expect them to stay the course with pre-announced capacity expansions like in the UAE, like in Saudi Arabia. The countries where increases are likely to come from are more likely to be countries in trouble. Think Mexico is just opening up now. You think the conditions they offer for private investors will get worse? They will get much better in order to get some investment. Think Venezuela, in big trouble if that oil price decline speeds up political change. They may come back up and stop their decline. Think Iran. If the sanctions are lifted with a lower oil price, you're more likely to see policies to attract investment than with a very high oil price.
Well, let's go to the room for the last question on what the outlook over 5 years will be in terms of the oil price to 2020, and just get a quick response from Christof. So if we can bring up question 3, the outlook for the oil price over 2020, which is sort of taking a 5-year outlook. What price will Brent crude oil average over the coming years through to 2020? 10 seconds, please. 1, 2, 3, 4, or 5. Place your bets. 60, 80, 100, or 120, 150. Okay, number 45% of the room is on $80. 34% are still holding on to $100, and 14% at $120. We like the optimism. 8% are down the other end of the scale. A little different than last year's vote, which we'll bring up in a minute. But Christof, your thoughts on that quickly?
Yeah, it's evenly distributed. I think what this indicates is what would follow from what I tried to say earlier. We are probably
sorry to interrupt you. This quickly brought up last year's result. 50% were on $120 a barrel. And if we can just bring back the vote just now. 14%. So it's moved across to $80.
More uncertainty. I think the key point is that it is probably not going to be the case that we see a sort of stable range of oil prices over the next 5 years like we had over the last 4 years. Everything we said, the resilience of shale and the fact that this makes for a drawn-out game between OPEC and North American producers, the potential for further political disruptions, which are forgotten for the moment in North Africa or in this region, the fact that there will be surprising increases in places nobody thinks about right now, and then most importantly also the fact that OPEC isn't dead. It just takes a breather. But at some point, with low prices, there will be members who get unrestful, and there will be a decision to be made identifying a floor or not identifying a floor. All that taken together, I think, points to me, if I would make any guess, more to a period of sustained volatility. And I'll add to this one important thing. If people agree that this, to some extent, is about market share, and that the key variable is investment, not current production, because of these technical characteristics of shale, what deters investment more than anything else? It's probably not a smooth adjustment to another corridor. It's probably volatility.
Okay. Well, that's a good place to conclude. And thank you, Christof, for your words. And we now will move on to the next segment of the morning. Thank you, Diala.